Earnings are coming for FedEx, ticker FDX. With the report tomorrow after the close, is this a buy or a trap? Quick note before we dive in, I'm sharing what the data shows, not telling you what to buy. Do your own research. Over the next few minutes, I'll give you the complete picture, what the company actually does and how it makes money, what the chart and the technicals are telling us, whether the fundamentals back it up, what Wall Street thinks, the catalyst coming up, and the part most people skip, exactly where this trade would go wrong. I look at everything through a swing trade lens. Setups to hold for roughly 15 to 30 days, not day trades and not forever holds. Stick with me to the end for the honest verdict. Let's dig in. Let's start with the company itself. What does FedEx really do, and where does the money come from? In plain terms, Oration, together with its subsidiaries, provides transportation, e-commerce, and business services in the United States and internationally. It's an industrials company and worth about $78 billion. To put that in context, that makes it a large cap, established, widely held, and relatively stable. Why does the business matter for a trade? Because it tells you what actually moves the stock, and whether a move has staying power or is just noise. With the what covered, let's get to the when. For a swing trade, timing is everything, and that starts with the chart. Onto the chart. This is where we figure out whether now is the moment, and I'll break down each signal as we go. Start with the moving averages. The 50-day average is the short-term trend. The 200-day is the long-term trend. When price is above both and they're rising, the trend is healthy. When it slips below, momentum is turning. Right now, FedEx is trading about 4% above its 50-day and 27% above its 200-day. So the trend is on its side. Next, momentum. The RSI runs from 0 to 100. Above 70 is overbought and can be due for a pause. Below 30 is oversold and beaten down. Here, it's a neutral, 43. Neither stretched nor washed out, which is a healthy place to enter from. And it's pressing right up against its 52-week high. That's strength, and a breakout to new highs has nothing but open air above it. A chart only tells half the story. Do the fundamentals back it up? Let's look at the growth and the valuation. On growth, earnings are up about 17% from a year ago, and revenue is up about 8%. That matters because rising earnings and sales are what ultimately pull a stock higher. The chart is the when, the growth is the why. Now, valuation. The forward price to earnings ratio is simply what you pay today for a dollar of next year's expected earnings. Lower is cheaper. At about 17 times, that's a reasonable middle of the road valuation. Let's bring in two more things: what the pros think and what's coming up on the calendar. On Wall Street, 16 analysts cover it, and on balance, they rate it a buy. Take analyst ratings with a grain of salt, by the way. They're often slow to change, and they rarely say sell. But a cluster of buys is at least a tailwind, not a headwind. Now, the calendar, and this is important. Earnings are due in just a few days. Earnings is the single biggest scheduled risk for a swing trade. The stock can gap 10% or more overnight in either direction, no matter how good the setup looks. So, if you take this, either size it small or plan to be out before the report. Don't get blindsided. Now the big one. FedEx reports earnings tomorrow after the close. This changes everything about the setup. Wall Street is expecting earnings of $5.91 per share versus $6.07 from the same quarter last year. That's a 3% decline year over year. That estimate comes from 9 analysts covering the stock. Analyst targets sit near 340, roughly where it trades now. Not much upside baked in. Short interest is minimal at 1.5%. Bears aren't betting against this one. Here's the bottom line on earnings. It's a binary event. The best chart setup in the world can gap down 10% on a miss. If you're holding through earnings, size the position so a gap won't hurt you. If you're not willing to take that risk, consider stepping aside before the report and re-evaluating after. Here's the part that matters most, the downside. Where is the FedEx thesis wrong? Let's be honest about both cases. Here's the bear case. What kills this trade? The 50-day trend line is your line in the sand. As long as price holds above it, the setup is intact. But if it breaks down and stays below the 50-day, the trend has flipped. The thesis is dead. And that's where you step aside. No hoping, no averaging down. And here's the bull case. If it holds that support and the trend keeps working, the path of least resistance is higher, and that's the move you're trying to ride. The honest truth is nobody knows which one plays out, so you don't predict, you manage. Decide your exit before you enter. Size the position so that being wrong at that level is a loss you can shrug off. Never bet the farm on one idea. And never let a swing trade quietly turn into a long-term investment just because it went against you. That discipline is the whole game. It's what separates traders who last from the ones who blow up. Every stock has two sides, so let's do both. The bull case and the bear case for FedEx. First, the bull case, what's working in a clear uptrend above its 50 and 200 day. Wall Street agrees. 16 analysts rate it a buy. Reasonable valuation at 17 times forward earnings. But here's the bear case. The risks. Earnings in 1 day. A binary event mid-trade. No stock is one-sided. A good decision weighs both, then sizes accordingly. So, FedEx, buy or wait. My take. This is a watch, not a screaming buy. The trend is intact and there's a lot to like, but I'd want a cleaner entry or a stronger confirmation signal before committing. Put it on your list and let it come to you. Whatever you decide, do your own research, size it right, and manage your risk. No single trade should ever be able to hurt you. If you got value from this, subscribe to MoneyQuest Lab. Fresh, data-driven picks every single trading day. And remember, this is educational only, not financial advice.